Hello traders, welcome back to the Forex Gig where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about the unbalanced volume indicator for swing trading. This often overlooked volume-based tool can reveal market momentum before price movement occurs. So stay with me until the end of this video to learn how to implement this strategy in your trading routine and potentially improve your entries and exit timing. What is the unbalanced volume trading strategy about? And this is a tool that is designed to measure the flow of volume in and out of the market. It works by calculating a cumulative volume total of trading volume based on price movement. When the closing price is higher than the previous close, the day volume is added to the unbalanced indicator, unbalanced volume indicator. If the closing price is lower, the volume is subtracted. If the price remain unchanged, the unbalanced volume indicator remains steady. This calculation creates a single line that reflects whether buyers or selling pressure dominates the market. The direction of this line is more important than its crucial value. A rising OBV suggests accumulation, where buyers are gaining control, while a falling or a failing OBV indicates distribution, signaling increased sell pressure. You can use this indicator to analyze trends and confirm market sentiment. For instance, if both price and the OB are making higher highs and higher lows. If both price and OB are making both higher highs and higher lows, this is a strong signal for an uptrend. And as you can see in this area, we can see the price is making a series of higher highs, higher lows, higher highs, making a series of higher highs, higher lows, higher highs, higher lows, and higher high. Then if we look at this indicator, we can see at that area, the OBV is making the same movement. Higher highs, higher lows, higher highs, higher lows, higher highs, signaling that this is a strong movement in the market. Conversely, if they are making lower highs and lower lows, it confirms a downtrend. The OBV also helps identify divergence between price and volume. If price is rising but the OBV fails to follow suit, it could signify weakened buying pressure and a potential reversal. Or if price is falling and it fails to fall, it could signify a weakened selling pressure. Now let's see how to swing trade with the unbalanced volume strategy. The swing trading with the unbalanced volume indicator provides you with a systematic approach to capture medium-term market movement. This strategy focuses on identifying key trend confirmations and divergence to time your entries and exits with precision. The unbalanced volume indicator trend confirms strategy confirmation. Confirmation strategy begins with analyzing the relationship between price action and the volume flow. When both price and OBV are making higher highs and higher lows, this confirms a strong trend with genuine buying pressure behind it. Conversely, when both are making lower lows and lower highs, it indicates a downtrend with sustained selling pressure, like we explained with the buying pressure over here. Let's look for a selling scenario to better understand what we are talking about. We look for when the market is making a series of lower highs and lower lows in a bearish market. and we see how the unbalanced indicator reacted at that area. As we can see from this area on the chart, price is making a series of lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, and lower low. Typical bearish setup move. Now you can look at the unbalanced indicator at that same area is making a series of lower lows, lower highs, lower lows, lower highs, lower lows, lower high, further confirming the bearish move. When we see an alignment between price and the indicator, it shows that it is a genuine pressure, either the selling pressure or the buying pressure. Now for your entry signal, you have to wait for situations where price makes a new higher high while the OBV indicator makes a corresponding new high in terms of a buying trade. Now let's look at a buying scenario like we are doing before. In a buying scenario, you wait for price to make a new high and the corresponding OBV would also make a new high. This dual confirmation suggests that the trend has momentum and is more likely to continue with the same principle. You have to apply to the downtrend with the same principle. Your position size should reflect the strength of your OB signal. Stronger alignment between price and OB warrants larger position size, while weaker confirmation might suggest more consecutive positioning. Now, we would want to enter the trade when we notice there is an alignment between price making a new high and the OBV making a new high. When price retrace, you see the OBV retracing. Once you notice the OBV is going back to the upside, this will be a good signal for you to buy enter your long position on the trade. Now, in a selling scenario, the reverse is the case. Still the same principle. All you need to make sure is that price is in correlation with the OBV direction. Let's say price is making a lower low in this area. As we can see, price is making a lower low, a lower high, a lower low, a lower high. You can see the OBV is following that same principle. So the moment we notice price have made a lower low on the OBV and is making the lower high, this could be a good entry point for us. The moment price continues to the downside, you would want to take your trade at that area. You put your stop loss and your take profit at a good area. Now, setting take profit targets is crucial for risk management. Always set your take profits, your stop loss just above the OBV support region. Now in this case, the OBV support region in this trade, if we can align this where we enter, the OBV support region is this area. So you just put your stop loss just above this area that aligns with the OBV. That's where you set your stop loss, and your take profit you can exit using the OBV indicator too. Once you spot a divergence between price and the OBV, you can decide to exit your trade, or you can exit at a fixed risk to reward of 1:2 or 1:3, as the case may be. Time frame selection matters with this strategy. Now for swing trading, you can use your 4-hour and your daily time frame to provide the most reliable signals for swing trading. When you are making use of swing trading, your best time frame for swing trading is your 4-hour and your daily time frame, because this allows you to capture multi-day or multi-week moves while filtering out the market noises. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. And if you found this video helpful, do not forget to like, share and subscribe. Turn on your notification bell so that you won't miss out on more trading tips and strategies. Thank you for watching, and I will see you in the next video.